Nvidia just reported $68 billion in revenue, but that wasn't enough for the market. Despite the record beat, the stock tumbled 5%. We're seeing the start of a major rotation as capital exits AI hardware and moves toward defensive assets like gold. It's the earnings paradox of 2026. Even a perfect scorecard is meeting a wall of skepticism. That perfect scorecard didn't stop a 5% sell-off because the market's focus is already shifting. We're seeing a significant rotation out of AI hardware and into software, where the IGV ETF is extending its bounce. At the same time, institutional money is moving towards safety. Eurodollar University reports that European banks added nearly 95 billion euros in government bonds in January, marking the second highest monthly jump on record. This caution, paired with what Macro Voices calls a new commodity supercycle in metals, suggests a defensive regime is taking over. Beneath the surface, the market is showing a significant rotation. Nana observes that large-scale capital is moving out of AI hardware and into software, marking a strategic pivot as investors seek software exposure over physical infrastructure. This shift is helping the IGV ETF extend its rebound. Meanwhile, a major safety bid has emerged in Europe. According to Eurodollar University, European banks increased their government bond holdings by nearly 95 billion euros in January. This is the second highest monthly jump on record and signals rising institutional caution. Macro Voices also suggests a commodity supercycle is reasserting itself, led by metals as a new structural regime begins to take hold. The core of the Nvidia sell-off is really a question about sustainability, and we're seeing that reflected in where the big money is moving. Institutions are aggressively bidding for safety and tangible assets, with European banks adding 95 billion euros in government bonds this January. That's the second highest monthly jump on record. Beyond bonds, Macro Voices highlights a re-emerging metal-led supercycle as commodities reclaim their role in a structural regime. This shift toward tangibles is the market's hedge, while the debate continues on whether AI spending will actually peak in 2026. While Nvidia's data center revenue hit a massive $62 billion, the market is now fixated on the sustainability of that spending. Goldman Sachs forecasts that AI capital expenditure will peak in 2026, with growth expected to slow significantly by year-end. Although analysts at JP Morgan and Citi argue that inference demand will keep orders high, recent price action suggests investors are weighing these peak capex fears more heavily, even as the stock trades at less than 30 times forward earnings. Wall Street is deeply divided on whether inference demand can sustain this level of spending. While banks like JP Morgan and Citi expect high spending to continue, the market is currently listening to the skeptics. Price action shows investors are weighing those peak capex fears much more heavily, even as Nvidia's forward valuation drops below 30 times earnings. Physical constraints are now emerging as a tangible drag on the AI build-out. According to CBRE, U.S. data centers under construction saw their first decline since 2020, with capacity dropping below 6 gigawatts. This slowdown is a result of a lack of capacity rather than a lack of interest. Reports indicate that aging power grids and permitting hurdles are stretching interconnection times to between 3 and 7 years. Jeff Curry at Macro Voices notes that while electrification demand is accelerating, the physical supply chains for power and materials are becoming the ultimate bottleneck for the next phase of growth. As the AI build-out hits these major grid bottlenecks, some stretching out 7 years, the hardware trade is starting to cool. This is pushing investors toward gold, which is shifting from a cyclical trade into a structural reserve asset for central banks. Beyond metals, we're facing a supply cliff in oil after a decade of underinvestment. Jeff Curry argues we're entering a new regime where global hoarding of strategic materials makes commodities, rather than growth stocks, the primary vehicle for preserving capital. As momentum in AI hardware cools, Macro Voices notes that gold's behavior is shifting. It is transitioning from a cyclical trade into a permanent hedge for central banks. In this role, it acts as a structural reserve asset that prioritizes capital preservation over growth. We're seeing a growing list of macro tripwires across global markets. Eurodollar University reports that major insurers like AXA and Allianz are stepping back from private credit, which suggests a tightening of institutional liquidity. Energy is a primary concern. A decade of structural underinvestment has created a fragile oil supply cliff. And while geopolitical tensions could cause price spikes, macro voices suggest that de-escalation could see oil target the high $50 range. Meanwhile, the US dollar index is testing the pivotal 98 level. Finally, visible alpha data shows that massive AI capital expenditures are starting to squeeze free cash flow for major spenders like Amazon. Moving to the watch list, technical levels are now the primary signal. We're monitoring Nvidia for a potential retest of the 160 to 170 range before expecting sentiment to firm up. For the broader market, keep a close watch on 6,800 for the S&P 500. A break below that level would likely trigger significant systematic selling pressure. On the technical watch list, watch for a potential retest of Nvidia in the 160 to 170 range before sentiment stabilizes. For the broader index, the S&P 500 faces systematic selling pressure if it breaks below 6,800. Finally, for gold, Macro Voices suggests a tactical collar strategy using GLD to stay exposed to the upside while defining downside risk. The market's next major test arrives in mid-March at the Nvidia GTC conference. This is the ultimate hurdle for AI sentiment, as we see if hardware growth can overcome the shift to a commodity-heavy regime. For full details and source links, check the description.